Hello everybody, welcome to today's fundamentals. Hello Peter.
Hello.
How have the markets been behaving?
Well, we had yesterday the US dollar edged lower. It was more or less a correction from the jump which the US dollar had on Friday. Practically the US dollar got some substantial support on Friday as the core PC price index accelerated, actually was beyond market expectations. And that highlighted the inflationary pressures in the US economy, both on a month-on-month as well as on a year-on-year level, and hardened the market's expectations for a possible hawkish Fed. That provided support for the US dollar and tended to weaken US stock markets. Yesterday we saw a correction in both instruments. On the one hand, the US dollar edged lower, while US stock markets edged a little bit higher. I would be noting though that also the durable goods orders growth rate, which declined into the negatives, may have contributed as well to the weakening of the USD. Other than that, I would be noting across the Atlantic, we had some developments and where there were a number of data which tended to provide, I would say at the best, not a shock, but definitely was stunning. For example, we had Japan's preliminary industrial output growth rate, it was for January, and it declined into the negatives. It was the deepest, widest decline since May. And that tended to pose some question marks about the outlook of the Japanese economy, especially given that the industrial production seemed to have contracted in cars, which is a key sector for the Japanese economy, and I would also be highlighting chips. On the flip side, we had good news from Australia. We had a current account balance which rose above expectations, and the retail sales growth rate accelerated also beyond market expectations. Both were in the positives for the Australian economy on a macro level. I would be highlighting though that Australians, or if you prefer Aussie traders, are expected to be quite busy in the coming days.
And how about the US stock markets?
Well, we mentioned that US stock markets edged a little bit higher yesterday. It was practically a move which characterized the Dow Jones, S&P 500 and Nasdaq. It tended to imply a slight improvement of market sentiment. It would be interesting to see whether that will be continued today as well. Should that be the case, should the market be a little bit more risk-oriented, etc., we may see US stock markets edging a little bit higher.
And what happened in the UK?
Rishi Sunak yesterday with EU chief Ursula von der Leyen announced practically that they seem to be agreeing on a progress regarding the Brexit deal. And practically the improvements are highlighting, I would be noting 4 sectors. They are lowering the trading barriers between Great Britain and Northern Ireland, because up until now we had a border as the Northern Ireland part was still considered economically to be EU, or at least adhered to EU rules. So that would be one. The second element which stood out was that the European Court of Justice still has oversight over the deal as such. The third element would be that there seems to be a mechanism which could be resolving some conflicts. Say, for example, Northern Ireland will be having practically a veto in case of new EU laws that they would not like to apply on their territory. And I would also be highlighting that there are some amendments on taxation rules. Now, the deal as such still has to be approved. And the focus now turns towards Northern Ireland's Unionist Party, the DUP. It's a small party, but its voice has an outsized effect.
Mhm.
And should they agree as well, I think it's going to be passing without any problems.
Mhm.
Overall, the deal which was announced tended to provide support for the pound. I would mention in general, it supported UK assets. Why? Because it more or less eases the tensions between the EU and the UK. And I think trading will become more straightforward between Great Britain and Northern Ireland.
Mhm.
It's a win-win situation in my opinion. And if it's being ratified, could provide some support for the pound further.
Mhm. And what's on the calendar for today?
Well, we already had the European session. I would be noting from Turkey the GDP rate for Q4 slowed down, but not as much as expected. It reached 3.5%, and I think that would be a positive for the lira. I would also be noting from Sweden the GDP rate, which declined into the negatives once again,
Uh-huh.
and it was a reversal on year-on-year level. I would also be noting that we had the GDP rates of France, which remained unchanged. It was the final release anyway. The interesting release from France was the preliminary HICP rate, and it accelerated beyond market expectations, reaching 7.2% year on year. That tends to highlight the inflationary pressures within the second largest economy of the Eurozone. And it's going to be interesting to see the developments in the coming days as well. Other than that, we had also Switzerland's GDP rate. It was for Q4. It slowed down beyond market expectations. It was expected to tick down from 0.2% to 0.1%. It reached stagnation levels at 0. On the other hand, though, we had also the COF indicator, which rose beyond expectations, implying that economic activity in the Swiss economy is improving.
Mm-hmm.
So we're getting some conflicting messages. Maybe I would be noting that the worst part may be over, but it's still a bit risky. Let's wait out and see.
Mm-hmm. And how about the American session?
In the American session, I would be highlighting definitely from Canada the GDP rates. It's for Q4. It's expected to slow down substantially from 2.9% to 1.5%. And should that be the case, we may see the CAD slipping.
Mm-hmm.
I would also be noting from the US Consumer Confidence Indicator, expected to improve somewhat, not much, but still, and that could provide some support for the US dollar. Other than that, oil traders may be more interested in the release of the AP weekly crude oil inventories figure. I remind you that in the last week the reading was a rise of US oil inventories nearly 10 million barrels. It was just below it. Should we see another substantial rise of oil inventories, that could weaken oil prices. And on the monetary front, I would be highlighting Chicago Fed President Goolsbee, who will be speaking.
Mm-hmm.
While we have also two speakers from BOE, Chief Economist Pill and MPC member Mann. MPC member Mann tends to be tilting towards the hawkish side. And should we see her comments once again highlighting this aspect, we may see the pound getting some additional support.
Mm-hmm. And what is due out tomorrow's Asian session?
Well, the Asian session may be the most interesting part of the next 24 hours.
Mm-hmm.
We have the release of Australia's GDP rate.
Mm-hmm.
Now the rate is expected to tick up on a quote-unquote level from 0.6% to 0.7%. Should that be the case, we may see the Aussie getting some support, but I think that Aussie traders will be also focusing on China's manufacturing PMI figures. Therefore, February, we're getting both the National Bureau of Statistics as well as the Gaixing manufacturing PMI figures. Both are expected to rise, both are expected to be above 50, showing growth in economic activity in the crucial manufacturing sector of China, which would be a positive definitely on a macroeconomic level for the Chinese economy. But that would also imply a wider degree of raw material exports from Australia to China, thus could provide some support for the Aussie. But I would highlight that the improvement of economic activity in China could be a positive for the global level of the economy.
Mm-hmm.
Why? Because of its size mainly.
And how about the rest of the week?
Well, there are two European releases which tend to stand out. The one
Mhm.
would be Germany's preliminary HICP rate for February. Given that we had an acceleration of France's preliminary HICP rate for the same month, should also Germany's HICP rate accelerate, that would more or less highlight the possibility of Eurozone's preliminary HICP rate accelerating as well, which may lead the ECB to have a harder stance, a more hawkish stance. I wouldn't be surprised to see the market fully pricing in a possible terminal rate for the ECB to be at around 4%.
Mm-hmm.
It's a big issue. The hawks in the ECB are dominant right now.
Mm-hmm.
So I think Euro traders are going to be glued on the seats about these two releases. And I would also be highlighting from the US.
Mm-hmm.
Now we're getting the ISM manufacturing PMI figure for February. That's tomorrow. And we're getting also the ISM non-manufacturing PMI figure. That's on Friday, if I'm correct. Now, the manufacturing PMI figure is expected to improve, yet to remain below 50. That would mean practically that there was another contraction of economic activity, a narrower one, but still another contraction. On the other hand, the non-manufacturing PMI figure is expected to widen and rise beyond 50, which would imply a faster expansion of economic activity in the sector and could provide some support for the USD.
Mm-hmm. Great. Thank you, Peter, for your time, and everyone for watching. Join us after a short break for technical analysis with Peter Yosif.
Welcome to the technical analysis part of the presentation for today. My name is Peter Yosef, Senior Market Analyst at IronFX. In front of your screens, you have the US dollar index. It's the 4-hour chart. All charts to be presented are to be of the same time frame, unless otherwise stated. Now, with no time to waste, let's make a small comment here. The US dollar index was on the rise. You can see how it was supported from an upward trend line, marking higher lows and higher peaks. Yet it seemed to have hit a ceiling after aiming for the R100 and 540. It's interesting how the index corrected lower after hitting on the upper Bollinger Band. And I would highlight the most interesting element of the movement may have been that the correction lower has broken the upward trend line guiding it. So that, in conjunction with the fact that the RSI indicator is running along the reading of 50, implying also rather indecisive market, tends to push us to switch our bullish outlook in favor of a sideways motion bias initially. Yet that would be between the 105.40 and the 103.75, pretty wide. Should, though, the bulls regain control over the index, we may see the price action rising. We would require the price action to rise above this peak here, and that would mean a slight, at least slight, breaking of the 105.40, and then continue to start aiming for the R2 106.80. Let's have a look where the R2 actually rests. It's on this peak here, which was at around the end of November. So it seems to be pretty valid, as does also the R3 readjusting. On the flip side, should the bears take over, we may see the price action dropping. For a bearish outlook, I would require breaking of the 103.75 support line, a level which provided support here and resistance here and here. Should that be the case, then the way is paved practically for 102.45, a level which provides support here and resistance here. Let's have a look at Euro USD. Similar but in a reverse mode, let's readjust the levels. Now the question mark here is whether the downward trend line has been broken, and it has not. But there is a steep rise, and the downward trend line has been broken, which tends to imply that we should be switching our bearish outlook in favor of a sideways movement initially. Note how the RSI indicator has risen, reached the level of 50, and it's revolving around the 50 axis, which tends to imply that the sideways motion is to continue. I think we're nearing a make or break situation here for Euro USD. Should there be another rise which would be pushing the pair higher above the upper boundary of the downward channel, possibly even higher than the 1.0655, and the pair starts aiming for the 1.0790, that would force us to switch our bias into a bullish outlook. On the other hand, a possible stabilization could be in the cards for the pair as well, yet I would like to see it breaking the upper boundary before actually switching our bearish outlook in favor of a sideways bias. In case of a sideways movement, Euro USD may break the upper boundary of the current downward channel, but most probably will be remaining between the 1.0655 and the 1.05. We're talking about 155 pips here. Quite possible. Pretty wide. In case the bearish sentiment maintains control, that would be practically pushing the RSI lower towards the 30 level once again. And that would allow for the price action to drop, possibly break the 1.05 support line. It's a level which provides support beautifully here. Next possible stop for the bears would be the 1.0310. Let's have a look where that rests actually. That would be on the 1st of December. Sorry, 30th of November actually. So we see how the level provided support here and here. So it's pretty valid. Okay, let's readjust. Once again, for the time being, there is an upward movement, yet to switch our bearish outlook, I would require the price action to break above the upper boundary of the current downward channel. Okay, let's have a look at cable. Cable, which was allowed to move rather independently. The movement lower on Friday. Yep. Tends to highlight though that the S1 is wrong. The S1, once again, the pair reached as low as this level. 1, 2. Now the question is, do we have a double bottom, a W formation? If that's the case, then I wouldn't be surprised, and this is the neckline, then I wouldn't be surprised to see the price action rising, breaking above the R1 1.2115, and even reach as high as 1.2265, a level which provided resistance here. Now this would be the 1.1925. Now, we discussed the possibility of an upward movement, yet that's also being supported by an upward movement of the RSI indicator. Note how it has reached, actually right now it's at 59, which is considerably high, should not be neglected, so that enhances the possibility of a bullish outlook. On the other hand, for a bullish outlook, I would require clear breaking of the R1, 1.2115. As long as the price action remains between the 1.1925 support line and the R1 1.2115, we maintain our our sideways bias. In case the bears take over, we may see the price action reversing direction, dropping, breaking the 1.1925, and aim, if not even reach, the 1.1840, a level which provided support here. Once again, I highlight, let me show it once again. We have a downward motion, upward be at lower peak, downward again, same level, upward again. So practically the double bottom formation tells us that it's about to reverse direction. The price action may rise, in my opinion, as high as this level, 1.2265. But once again, for a bullish outlook, we would require clear breaking of the R1 1.2115. Let's have a look at USD/JPY. Okay, an interesting move in the sense that it has broken clearly the 135 resistance line, which we now have to reverse into a support line. Let's go hunting for a new ultimate resistance level. Unlocking the chart. Note this peak here. It's very interesting how this level was able to reverse the upward movement here. It was a very slight one, but went down again. And that would be in red, 142.20. Looking it in, readjusting the chart, widening it, and let's reposition the labels. Let's make the necessary corrections here. Starting with the S3, which is now being placed at 130.40. The S2 at 132.85. The S1 at 135. The R1 at 137.80. The R1 at 139.90. And the R3 at 142.20. Now, direction. I have to tell you guys, back at the research desk, there was a strong opinion that we're missing out on the big picture regarding USDJPY. They have to stress that. And what those guys told me was the following. If we drill to the daily chart, then you can see a wider upward trend line. Let's skip this. Let's simplify it. You can see the jump. There was a wide drop. A temporary stabilization. Let me encircle that. And the move now is going upwards. I wouldn't say no. I would be accepting this. However, I would also add that it's more suitable for more long-term trading. But it's something which we should bear in mind. Now let's drill to the 4-hour chart. We had before. I would say that we have a stepped course in the sense that one level was here. Then the next level was here. And we had a third stabilization here. So we have 1, 2, 3, and note the upward movement once, twice. Now we're entering the third one. Overall, that tends to imply that there is a clear upward movement, yet it's a little bit more long-term and should not be neglected as an idea. But if we drill to the 1-hour chart, or even the half-hour chart, you can see the stabilization, and you can see how the pair is actually trying to escape it. Back to the 4-hour chart. The RSI indicator is at the reading of 90, which is very bullish in my opinion. It's not that extreme, but it's very bullish. So I wouldn't be surprised to see the price action rising further, breaking the 137.80 and start aiming for the 139.90. There's still some room between the price action and the Bollinger Band, the upper Bollinger Band. Note how the price action was able to break above it. Note the 1, 2, 3 white soldiers, which brought about the stabilization later on. I think we are in for a bullish outlook here. Let me delete the eclipses so it becomes less confusing. As long as the price action remains above the upward trend line we have drawn, and that's since the 2nd of February, we tend to remain bullish. Let's have a look also where the 137.80 as well as the 139.90 actually rest. Let's recheck the validity. So we have two touches at the 137.80 level to the upside as a resistance line, but also note that it provided support, so it's a pretty valid level. The 139.90, this one here, provided resistance, some support. Not so valid, but still seems to be present, so I'm keeping them. So let's sum it up. A, we maintain a bullish outlook. Why? Because the price action is supported by an upward trend line since the 2nd of February. B, because the RSI indicator is at the reading of 70, actually implying a rather bullish sentiment on behalf of the market. Should the bulls maintain control as expected, that's the second element, then we expect it to break above the 137.80 and start aiming for the 139.90. That's the bullish outlook. Should the pair stabilize though, then that would practically be signaled by the price action remaining relatively unchanged and breaking the upward trend line. The breaking of the upward trend line would be signaling exactly this change of trend. And that would be signaling the change of trend from an upward movement towards a sideways movement initially. Now, for a bearish outlook, I would require A, the price action to break the upward trend line, but I would also require it to break the 135 support line, with the next possible target for the bears being the 132.85, the S2 level, a level which provided resistance. Actually, it's resistance here, resistance here. So it's a former resistance line which has now been turned to support line as the price action has moved clearly above it. Okay, let's have a look at USD CHF. Interesting enough. So we have an option once again, but to tell you the truth, guys, I would be feeling far more comfortable with a bullish outlook should I see another peak which would be higher than this one. So yes, there is a bullish outlook. I would expect the price action to break above the 0.945 and definitely have its next peak somewhere here. On the other hand, note that the R1 seems to remain strong. It was tested, briefly broken, but seems to be the one which forced the price action of USD CHF to drop down again, once again, correct lower if you prefer. The RSI indicator is currently at 50, give me a sec, 61.9, actually almost 62 and rising. So that tends to imply that there is also a bullish sentiment in the market. Okay, so the bullish outlook is on. On the other hand, should the pair stabilize, then I would expect it to break the upward trend line guiding it to remain between the 0.945 and the 0.9275. For a bearish outlook, however improbable that may sound, it's still a possibility and should be covered. I would expect the price action A to break the upward trend line, once again, first sign of a changing trend, and I would also require it to break the 0.9275 support level. That would be paving the way for 0.9145, which was the low boundary of its past sideways motion. Let me also reposition the S3. Okay, let's have a look at the RC. Intense downward motion. Clear. Okay, definitely we have to make some corrections here. The S1 and the S2 have been broken clearly, have now to be turned into resistance lines. Let's unlock the chart. Let's go hunting. I would be setting one here. This is too narrow. This is too wide. Somewhere here. This is a resistance level here. And a support line here. Okay, let's actually for a support line I would be moving here. And the next one could go even lower. Oh yeah, here. See this peak here? In my opinion, that tended to provide resistance at this level, yet also provided support a number of times. So it's interesting how that puzzled the price action of AUD/USD. And that would be in green, sorry. Cancel. In green, let's have a look at 0.6450. And this would be 0.6285 in green. Okay. Rearranging the chart, narrowing it. Let's reposition the labels as well. Let's start with the R3 at 0.7010. The R2 at 0.6880. The R1 at 0.6740. The S1 at 0.6585. The S2 at 0.6450. And the final one, S3, 0.6285. Locking everything in. Bearish outlook is being maintained as long as the price action remains below the downward trend line. Note also how the 20, the 50, and the 100 moving averages all point downwards. There is still room between the price action and the low Bollinger Band for the pair to move lower. The RSI indicator, on the other hand, is rather low. It's at 37. 37, but seems to be slightly rising. That could be a warning that we are about to see the bearish effect slowly fading away. Should the bears maintain control, we may see the price action aiming, if not breaching, the 0.6585. On the flip side, should there be stabilization, we may see the sideways motion being maintained below or around the 0.6740 level. Definitely a breaking of the downward trend line would be required in this case. And should the bulls decide to take over, we may see the price action rising, breaking the R1 0.6740 and start aiming for 0.6880 R2. Let's have a look at USD CAD. Steeper rise. There are some stabilization levels here, or signs if you prefer. Nevertheless, for the time being, let's correct support and resistance lines. Definitely the R1 has to be switched into support line given that the price action has moved decisively higher. Readjusting the chart. Let's go hunting. Okay, this is a pretty narrow one, but still a peak. Let's have a look wider back. No, nothing of interest back to October, so let's readjust. But I'm sensing that the support lines are pretty wide and we could narrow them down. Definitely this one is a support line, which we missed on it. Note also, the peak here, support here, resistance here, support here. Seems to be pretty valid. $1.3520. By the way, let's correct this one as well. 1.3975 in red. I would be narrowing this one here as well. In green, 1.3365. 33.85 remains. And this would be the 1.3520. Let's widen the chart just a bit. Let's reposition the labels. 1.3975. 1.3850. Sorry, 50. Yeah, 50. 1.37. The S1 now is being placed at 1.3520. The S2 is being placed at 1.3365. And the last one at 1 point, let me check that. Dark green 1.3255. So our chart is ready. For direction, we tend to maintain a bullish outlook as long as the price action remains above the upward trend line guiding the pair since the mid of February. We highlight though that there are signs of stabilization. And the first is that the RSI indicator has dropped and is just above the reading of 50. It's actually right now at 52, 54. Note also how the price action is flirting with the upward trend line and is about to break it. Should it be successful in having a clear break, that would force us to switch our bullish outlook initially in favor of a sideways motion. Should the bulls remain in control, I would expect the price action to rise and break the 1.37. While should there be a stabilization, I wouldn't be surprised to see it remaining in the spectrum just above the 1.3520. For a bearish outlook, I would require for the price action to drop, break the upward trend line, break the S1 1.3520, and start aiming for the 1.3365. That should be it from all of us here at IronFX. Best wishes for solid trading.
Hello everybody, welcome to today's fundamentals. Hello Peter.
Hello.
How have the market?
Everyone, welcome to another
Okay, hi everyone. Welcome to today's webinar. So today we'll be doing Fibonacci series, our first part of 4 on retracements. So we'll give a couple more minutes to let more people join our meeting. I will start perhaps at 6:05. So you can, in the meantime, you can grab a drink, get yourselves comfortable, and then we'll start in a couple of minutes. Maybe in the meantime, I'll do like a sound check. Can everyone hear me? And can you see my screen? Yeah, okay, that's great. Chat is disabled. Okay, let me try and sort that out. Thanks for letting me know. Okay. Okay, maybe you can try the chat again. I've just tried to refresh the chat. It says everyone can type in the chat. Hmm. Okay, let me try and figure that out. But this Q&A works. I can see all of your questions, so that's great. Okay, let me try and figure it out. Okay, can you try now and let me know if it works? Okay, that's great. Okay, there was something with the settings. But yes, I've managed to figure out. Yay. Okay, how's everyone doing today? Yes, Sven, it works now. No problem. Okay. So, where are you guys from? Today is actually my first webinar in a couple of months. So it's good to be back. No, today our is the first session for the Fibonacci series. So it'll just be on retracements. Things like the expansions, extensions, and projections will be in the coming weeks. So today we're just solely focusing on retracements. Wow, Finland and Germany. I bet it's really cold there now. Singapore is hot all year round, so I can't relate. Okay, I'm just checking to see if everyone is here. See if I should wait a little bit longer. Yeah, because people are still joining the call, so just be patient with me. Okay, Sven says it's -3 degrees right now in Germany, and in Singapore it is, I think, 27. So -3 must be so nice. I'm sure the weather is like so nice and relaxing. Whereas in Singapore we're constantly sweating. It's uncomfortable. Remember, you guys can just let me know in the chat throughout the webinar if you have any questions. Oh, we have someone from Mozambique and another from Africa. That's so cool. I forgot how international these webinars are, so it's so nice to speak to people from all different parts of the world. Okay, I think we can begin. Okay, yeah, let's begin. So, hi guys, I'm Melanie. Today is my first webinar, so be patient with me as I get back into the swing of things. But today we'll be going through the first part of our Fibonacci series. It'll be on retracements. So if you have any questions on projections or extensions, expansions, we'll be touching a little bit on that throughout the webinar, but we'll go more in depth in the coming weeks. So as usual, our disclaimer, the information in this webinar should not be considered as investment advice or recommendations, and it's solely educational material only. So take any piece of information from this webinar at your own risk. And IronFX is not responsible for any loss arising from any information contained herein. Okay, so this is me. I'm Melanie. Yeah. Okay, let's just begin. Okay, so here's our agenda for today. Firstly, we'll be going through the essentials of Fibonacci retracement, followed by the ideal market structure. So what you can look out for, significant swings, how important it is to follow market trends. And then we'll be going through the different Fibonacci levels. So we'll also be touching a little bit on expansions as well as Fibonacci extensions. We'll also be talking about the difference between those as well and how to look out for them when you're trading. So after that, we'll be going through how to combine the Fibonacci retracement levels so that you can increase your chances of a profitable trade. And then we will introduce something called the Fibonacci confluence area as well. And then, this is a typo. After that, we'll be going more in depth, talking about the negative Fibonacci levels as well as the levels more than 100%. Okay, so let's begin. So here's a simple checklist to follow when first starting out with Fibonacci retracements and some things to look out for. So firstly, is the market structure clear? So we like to look for really big zigzags. I'll show you what we mean in the coming slides. Secondly, we want to identify recent trends. So is the price going up or down? It's important to always follow the general trend. So you can see in the image that I have included over here at the bottom, our starting point is at the top and our ending point is at the bottom. So we can see that there's a very clear downward trend. Okay. Thirdly, you need to identify recent major swing lows and recent major swing highs. So we'll also show you some examples of this in the coming slides. So it's also important to connect the two extreme points, so from highest to lowest or lowest to highest, depending on the general trend. So we'll show you why this is important in the next few slides as well. So over here, we have an example of insignificant swings. So you can see the charts are rather choppy. There isn't really a very clear price movement. And this is what you want to avoid. So this is an example of something that you should not use Fibonacci retracements for. Okay, and this is something that you should look out for, significant swings. So something that has very obvious peaks and peaks and troughs. Yeah, over here. And a very clear move up or down. You also want to make sure that you look for a very clear market structure. So Fibonacci retracements should not cut through too large areas of the market structure. You definitely can, but it shouldn't deviate too much from the price movement. So in this case, we can see there is a zigzag structure, and the retracement drawn here cuts through the market structure, which makes it less effective. So when drawing your trend line, you want to make sure that it doesn't deviate too much. Because you can see from here, our starting point is here and our ending point is here, which cuts through a very large area of the price movement. Okay, let me just check. I'm just checking the chats to see if we have any questions. Okay, someone asked what time frame should be used. I'll get into that in a second, but mostly we want to use the larger time frames so that there's less noise when you're trading. Okay, so this is an example of something that you want to do. So you want to pick market structures with really clear upward or downward movements. As you can see over here, the starting point is at 0.1, ending point at 0.2. So you can see a very clear downward general trend. Even though it does cut a little bit over here, but that's fine because it doesn't deviate too much from the price movement. Okay. So answering your question earlier, these tend to work better on higher time frames. So like H1 onwards, H1, H4, and so on and so forth, because there's less noise compared to your M5 or M15. Okay, so this is an example of a clear market structure. So although Fibonacci retracements definitely can be used for both choppy and trending markets, and what I mean by trending markets is markets that have like a really general trend, like earlier in the earlier slides. But over here, you can see there's quite a bit of movement, but the Fibonacci retracements can be used for these as well. But it's important to look for clear market structure. That's the main point. Over here, you can see this is an example of an unclear market structure. Okay. So one thing we can do to find clearer market structures for our Fibonacci analysis is to adjust the time frames so that the market structure is clearer. So what might look messy on an M30 chart might look very clear on an H4 chart. So I'll show you in the next slide. So if there's too much chaos in the shorter time frames, it doesn't mean that the entire currency pair is not able to be analyzed at that point of time. It could just mean that you need to take a step back to get a clearer view. So I'll show you what I mean in this upcoming slide over here. So this is an example of a chart on an M15 view. So you can see there isn't really a very clear trend, no clear market movement as well. But if we zoom out and we look at the 1 hour time frame, it's quite clear, especially in this highlighted area. So we have much clearer movement, and it's less messy compared to the M15 one. Okay, any questions so far? No? Okay, let's move on. Okay, so from the past few slides, this first section, it's important to note that the clearer the swing low or swing high, the clearer the trend between the 2 points, the more accurate your Fibonacci retracement will be. So that should be the main takeaway from the first few slides. Okay, so now that we know how to draw Fibonacci retracement trend lines and we know what to look out for, let's look at the different types of levels ranging from negative all the way to more than 100. So in the negatives, we have minus 61.8 and minus 27.2, which are classified under Fibonacci expansions. And all of these in the middle are your Fibonacci retracements. And then above 100 will be Fibonacci extensions. So like I said earlier, we'll go in more in depth in the coming webinars, but we'll just briefly introduce them and how to go about using them as well. Okay, so over here, it just shows you an example of all of the levels that I've mentioned earlier. So for here, the starting point is at this level. Ending point is over here. Okay, so here's an example of the Fibonacci expansion and how it plays out. So our starting point is here, ending point is here. So for expansion, you want to look for a flash zigzag, which you can see over here from the arrows. It's like a flash kind of symbol or a lightning bolt. So you want to look out for these when you identify Fibonacci expansions. So you retrace the mid-range from here to here. And you make use of the support in the negatives, which means like the negative 27.2 and the negative 61.8. So we expect price to retrace back up to the 61.8% level because price has tested this level earlier, as you can see over here. So it tested this level and then it reversed off. So we expect it to come back down to this negative 27.2 or even negative 61.8. So I'll show you in the next slide how it actually plays out. So here we see the price really reacted off of our minus 27.2%, and then it came back up to our ending point. So typically price, not always, but typically price will come back to the ending point after bouncing off a negative Fibonacci retracement. Sorry, a Fibonacci expansion level. Okay, so let's move on to Fibonacci extensions. So those beyond 100%. So when using the 127 and 161.8 levels for extensions, we want to look out for the V shape or Nike tick as shown here. So in this GIF, you can see how price bounces off of these levels. Let me just start it all over again. Okay, here. This is our starting point. The shorter end of the tick is your starting point and ending point. And then price will continue to rise from these levels. And after it's reached this level, it reverses off it. We can see over here that it tested the level once again, but it ultimately bounced off it to reverse and drop back down. Okay, let's move on to the next slide. Okay, so when does a Fibonacci retracement become invalid? So one of the most common scenarios of this is when price makes a lower low. So assuming you are drawing a Fibonacci retracement from the top to the bottom, if there are bars on the right that break your ending point, it becomes invalid. So there are Fibonacci retracements that are negative, so like the negative 27 and negative 61.8. And we'll touch on these as they go basically beyond the endpoint, and yet they are still valid. So I'll show you what I mean over here. So this is an example of an invalid retracement. So the ending point, which is here, you can see that price actually reversed off the ending point, but it made a lower low. So this Fibonacci retracement over here, the trend line, is now invalid. Sorry. So similarly, if it's going higher, if it breaks the ending point and it goes even higher, then it's invalid as well. Any questions so far? No questions? Okay, let's move on. Okay, repeat the last bit. Okay, so how you identify once your Fibonacci retracement is invalid is when, so you can see over here, price is moving downwards. In this case, it's a downtrend. So when it's moving down, do you use this lower low as a new ending point? Yes, correct. Yeah. So you can see it's moving downwards. This is originally our ending point. But since price reversed off this level and went even lower, so this should be our new ending point. So even though I said earlier that you shouldn't cut through the price movement too much, in this case, it's not a large area, so you can still cut through this area because the general trend is still downwards. So this should be your new ending point. I hope that's clear. Okay. Any other questions? See the previous slide. Sure. No worries. So the main key point is that once it breaks your ending point, it becomes invalid. Okay. Okay, let's move on. So now let's take a look at Fibonacci extensions. So here you can see a very obvious Nike tick. The starting point is here, ending point is here. For Nike tick, you want to take the shorter end of the tick, the starting point. So you retrace this area, this trend line is over here. And it results in a reversal over here. When you use this trend line, it gave us a 161.8 projected level. So we are expecting it to rise to this level and reverse off of it. Oop. So 127 would be perhaps in between here. So you might want to wait for price to break through the 127 level before going in for this trade at 161.8. Okay. Okay, let's move on. So we've gone through earlier the key Fibonacci levels that work, the expansions, extensions, as well as the retracements. So there's always a huge debate on whether some levels work better than others, but the truth is that Fibonacci retracement levels work sometimes, but they work all the time. So that's the problem. So how do we minimize this issue and increase our chances of being profitable? So what we've come up with um, that works is by combining Fibonacci retracements. How do you expect that it will go to 161 and not 127? Okay, so so as I mentioned earlier, 127 would be perhaps around this area. So you might want to wait for price to break through the 127 level before going in for the trade for 161. Because at the 127 level, it could reverse or break through. So you want to wait for it to break through before going in for the trade at 161. Does that make sense? Okay. Okay, no worries, because let me just try and explain it again. Because the 127 level is obviously below the 161 and above the 100. It's in between. Should be in between this area here. So if price hasn't reached the 127 level yet, it's not advisable to go in for the trade at 161 because it hasn't broken the level yet. So it could reverse off of the level or it could go up. So in this case, we know that it went up. So after it breaks through the 127 level, then we can go in for the trade at 161 projected level. Okay, I hope that helps to clear things up. Okay, so let's talk a bit about combining the Fibonacci retracements. So the trick is to find multiple Fibonacci retracement levels that line up together so that you can increase the probability of a bunch of Fibonacci retracement levels working instead of a single Fibonacci level working. So this is the definition of Fibonacci confluence. So we'll show you an example of what we mean and how this can play out in the next few slides. So, okay, maybe I'll start with this photo first. So over here, we have a negative 27% Fibonacci retracement. So you can see this is the starting point and the ending point is here. Okay, so then we have a 161.8 Fibonacci retracement. So that would be starting point here, ending point here. And then we have a 78.6% Fibonacci This should be Fibonacci retracement, sorry. The 78.6. So that all lines up nicely and we expect price to bounce off of this confluence area since all three of our Fibonacci levels line up together. You can see that price really bounced off this area and it resulted in an uptrend after that. Okay, I have a couple more examples, so if you're a little bit confused, don't worry about it. But if you have any questions, you can pop it in the chat as well. All good. Okay. So here's our first example. So we have a Fibonacci retracement starting from here and ending here. And this gives us a 50% Fibonacci retracement. And the level is in yellow, this level over here. So that's the first one. Secondly, we have a Fibonacci retracement starting from here and ending here. And this gives us this green area over here. And then it lines up nicely with the 50% Fibonacci retracement. Okay. So lastly, we have a 127.2% Fibonacci expansion starting here and ending here. So ultimately, we have 3 Fibonacci retracement levels all lining up, and it gives us a very strong Fibonacci confluence area. So what we expect is that what we're going for is to play a bounce from a strong area of Fibonacci confluence support, which is basically all the colors lining up this area. Okay, so we'll show you the result of this. So as you can see in this picture, price went down to touch this strong area of Fibonacci confluence support, and it bounced up nicely. Okay, any questions so far? Yeah, so you're combining one big Fibonacci retracement level with 2 other smaller Fibonacci retracement levels. So you can see this is the really big one, and then you combine it with the 2 smaller ones over here, the green and the red. So you just pull out your Fibonacci retracement levels, and then you can just connect from the starting point to the ending point of each. And then you see where the levels line up, and that should give you a strong area of confluence. Okay, hope that clears things up. Okay, let's move on. So here we have another example. So in this example, we combine one Fibonacci retracement with 2 Fibonacci extensions. Okay, so the very first one, let's start with the yellow one. Starting point here, this is our middle point, and our ending point is here. So this is the Nike tick that we mentioned earlier, the Fibonacci extension. Okay. And it gives you an 88% Fibonacci extension, which lines up with the 61.8% Fibonacci retracement. Starting point here and ending point here. You can see a very clear downtrend here, the green arrow. Okay. So for the last Fibonacci extension, we have another flash over here, the red arrows. So remember, for Fibonacci extensions, we're looking for the flash symbol or lightning bolt symbol, however you want to call it. So for yellow, it's like this. For red, like this. So for red, it gives us a 61.8% Fibonacci extension. So we can see that all these 3 levels line up. and it gives us a strong area of Fibonacci confluence to trade from. So what I would do is wait for price to make a push up to this area, because currently price is at this red line here. So I wait for price to make a push up to this area, and when it touches this area, then I would short the market and play the drop. Okay, so this is what I mean. By waiting for it to go up to this area and wait for the reversal before you short. Any questions about this second example? Okay, so let me just go back to the previous slide. Yeah, so here you can see there's three different Fibonacci, two different Fibonacci extensions, as well as one Fibonacci retracement. So the Fibonacci retracement is the one in green. Fibonacci extension is the yellow and the red. And how you know this is because of the flash symbol. So like, it's like a lightning bolt. Yeah. Okay. I'm just reading some of the chats or the questions. Okay. Okay, I'll move on. So for the third example, we're bringing in support and resistance levels. And this leads to really high probability setups. So here is an example of how we combine pullback resistance and two Fibonacci retracements as well as a Fibonacci extension. Okay, so I'll show you where each of them are. The red level over here is the pullback resistance. Because price tested this area, it bounced off of it and it crossed this area over here. So this is a pullback resistance. The Fibonacci retracement is the yellow line, starting point here and ending point here. This gives us 61.8% Fibonacci retracement, which lines up with Fibonacci extension, which is over here. You can see the flash sign again in the green arrows. Can you guys hear me? Someone said they can't hear me. I think the audio is fine. Okay, let me just reply. Sorry. Okay. Where was I? Okay, yes. So you can see the flash over here, the flash signal. This is a Fibonacci extension, the green arrows. And then we have another Fibonacci retracement, which is the red arrow. Okay. And all of these three levels line up with our pullback resistance. So it's a very strong Fibonacci confluence. And it's also a high probability reversal zone that has the potential to see price reverse strongly from this area. So in such situations, you could place a short entry over here at this area. Let's see how this played out. You can see price reversed off of this area. And it reversed right as it hit the confluence area. So because this area is so strong, and you can tell based off of the Fibonacci retracements lining up, as well as the pullback resistance, or any support and resistance levels that line up with the Fibonacci retracements, should give you a very high probability reversal zone. Okay. Are there any questions about any of the three examples that we've gone through so far? Yeah, I'll give you guys some time to digest what I've just gone through from the three examples. Sorry, catching a cold because it's been so rainy in Singapore. Okay, so the main point from all of the three examples is basically to stack a bunch of Fibonacci retracement levels or support and resistance levels to try and get the most high probability confluence area that you can get. And then see whether it has a high potential for price to reverse off of it. Okay, let's move on. So here's some trade management tips with the Fibonacci confluence. So for stop loss, it should always be beyond the key Fibonacci confluence area. So the reason for this is because more often than not, price is attracted to such strong areas of Fibonacci confluence. And if your stop loss is right before instead of beyond it, you'll most likely get stopped out right before the market reverses. And this is one of the reasons most people wonder why they get stopped out right when the market starts to reverse, and then they complain about it. So, but not you, because now you know. So you can see over here, your stop loss is below it or beyond this Fibonacci confluence area. So there's some buffer over here. So just in case the market doesn't go exactly how you expect it to when you buy, so your stop loss is there's some leeway. Okay, so let's move on to the take profit. So your take profit should always be before your Fibonacci confluence. I see the slides are slightly incorrect, but for take profit, it should always be before key Fibonacci confluence area. And the reason for this is because when price reaches the confluence area, there's a high chance that it will not be able to go beyond it. So you can just ignore the slide here, but take a look at the image below. So our take profit is before the big confluence area. Why? Because there's a high chance that it will not be able to go beyond this area. So instead of reaching your profit target, it might reverse back to your entry, or even worse, your stop loss. So this is one of the reasons why people may complain that the market is being manipulated, because they miss their TP, their take profit, by 1 pip. So you should always put it before the major Fibonacci confluence. As you can see, there's also some leeway over here. So there should always be a little bit of buffer between the Fibonacci confluence as well as the take profit and stop loss. More of like a just in case measure. Are there any questions? Okay, I think there are no other questions. So that brings us to the end of our webinar. Okay, so before you guys go, let me just pull it up. So IronFX actually has a VIP trading room. I'm not sure if you guys know, but I'm just gonna let you guys know right now. So depending on your deposit, you can access the different premiums. This is on the ironfx.com website. So you can just take a look over here and you get VIP room access. And what I mean by that is over here, this brings you to our page. So let's say, for example, today we went through Fibonacci retracements. So you've been through our webinar, but it won't really help unless you have the space to practice. So the VIP room gives you the space to practice however you want. Let me just remove everything. So we have Fibonacci retracements, extensions, any horizontal rays that you guys want. So for example, if I see that this is a resistance and I'm not sure if my analysis is correct, you can go ahead and type a message in the chat box. So like maybe Desmond, hey. You can see that there are a lot of people in this chat. So if you put it in, there are many people who will be willing to help you, as well as some of our pro analysts as well. I am also in this chat, so you can go ahead and type it in. I don't know why it's not showing up. Okay, but you can tag whoever you want. Hey Desmond, is this resistance valid? And then you can highlight the resistance, link object to text, and then click on this. And then you can just send it in. So we try to reply as soon as possible. I think within 24 hours, you should get an answer. Yeah, so if it works for Fibonacci as well, if you want to check your retracement, like, is this valid? You can go ahead and tag that as well. Link object to text, and then you can choose which level you want. So maybe like 50%, and then it will choose it for you. So confirm, and then when I go over it, it will highlight it. So whoever is reading your chat will know what exactly you are referring to, and they'll be able to help you better. Same for the Fibonacci as well. 50%, so you can see the 50% is being highlighted. Okay. Okay. If there are any other questions, you guys can drop them in the chat. But if not, yep. Thank you guys so much for coming today. Let me just open the chat. Okay. Yeah, thank you guys so much for coming today. Have a great rest of your week. And I'll see you guys next week. Yeah, I think there is a way to see the recording. I don't think you can download the presentation slides, but the recording for this webinar, yeah, it's being recorded. Let me just see where you can find it. I think you can check the IronFX page, the website. Okay. Any other questions? No? Okay, thank you guys so much. I'll see you guys next week. Yeah, this may be a little bit difficult to understand, but no worries, you can go back and watch my presentation again. Um, and practice it on your own in the VIP trading rooms, and we'll definitely help you out over there. I think it would help you understand better if you actually played around with the Fibonacci retracement levels. Thank you guys. Bye.
Hi everyone, welcome to another IronFX live TV video. In this video, I'm going to talk about swap or rollover. So, what is a swap? Swap is the interest paid when the market rolls over. Every day the Forex market rolls over, which means your trade is carried from one day into the next. So basically a swap refers to the interest earned paid for keeping a position open overnight. If you're paid swap, the cash amount will be added to your balance. If you charge swap, the amount will be deducted from your balance. Swap charges are usually small but can add up over time. There are two swap types, swap long for long positions and swap short for short positions. Both types are expressed in pips per lot and vary depending on the financial instrument that you're trading. One way of profiting from swap rates is the carry trade. This involves buying a currency with a high interest rate while selling a currency with a low interest rate. You will earn a profit on the net interest of the difference. If you close your positions before the end of the trading day, which is known as the rollover point, you will not owe any charges or earn any swap interest. The interest rates for different foreign currencies are based on decisions taken by the central banks. The amount credited or charged to the trader can also depend on a number of factors, such as the difference between the interest rate of currencies, the Forex broker's commission rates, the day when you open the position, or the price movements of the currencies. Thank you for watching.